Hello, everyone, and welcome. We have a great event in store for you today, but before we begin, I'd like to take a moment to first extend our gratitude to the many who have been working so hard to keep everyone safe and well in this challenging time. I also want to recognize that our nation celebrates Veterans Day quite soon, and there is a strong historic association between Darden and the armed forces. And so we'd like to say thank you to all of our veterans for your service. By way of introduction, I'm Rodney Sullivan. I am the Executive Director of the Richard A. Mayo Center for Asset Management here at the University of Virginia Darden School of Business. And it is my pleasure to welcome you all here for our 13th annual University of Virginia Investing Conference. The Mayo Center is a center of excellence here at Darden with a focus on applied academic research and education. And consistent with that mission, the purpose of this event is, of course, to advance the study and practice of asset management through research and education. I'd also like to take a moment to thank our co-sponsors in helping to make this event possible: McKenna, Sands Capital, and CFA Virginia. Thank you. We have a great lineup of thought leaders in store for you today. Beginning in just a moment, they're going to share with you their insights on the rise of ESG investing. And we hope that you find this event useful in your daily lives. Before we begin, let me share just a few housekeeping items with you. All participant microphones have been muted and videos are turned off. For those having questions for our speakers, please send them via the Q&A box located at the bottom of your screen, and we'll collect them throughout the session and put as many of them as time allows to our speakers and panelists. In the coming days, we'll also post a recording of select sessions on our website, and we'll follow up with you with an email once these links are available. Okay, with that, now let's get started. It's my pleasure to introduce our moderator for our keynote session, Celia Dallas. Celia is the Chief Investment Strategist at Cambridge Associates, where she is responsible for formulating the firm's global investment strategy and portfolio construction philosophy. Also of note is Celia is an alum of the Darden School of Business. Celia, thank you so much for being here, and over to you to introduce the first session.
Thank you, Rodney. It's a pleasure to be here, and I am thrilled to welcome David Blood. He is the co-founder and a senior partner at Generation Investment Management, who is truly a pioneer in developing sustainable investing. Prior to arriving at Generation and forming Generation, David spent about 18 years at Goldman Sachs. He also serves on a variety of charitable organizations on the boards, and these organizations are primarily looking to solve some of the challenges associated with economic and environmental and social sustainability issues. So we will hear from David some introductory comments, and then we will engage in a conversation, and I'll save about 10 minutes towards the end for questions from the audience. So looking forward to hearing your introductory comments. David, welcome.
Well, thank you, Celia. And thank you all for allowing me to join this virtual conference. And I hope what we have to share with you today is of interest. The first thing I want to say, just to be provocative to start, is that we don't recognize the rise of ESG investing. We think that all investing should be sustainable. All investing should incorporate ESG in how one understands the quality of business and quality of management. And we do not think that it's sort of a separate genre in the investing world. And I'll explain why I'm saying all that as we go forward. But just to say, we think sustainability and ESG is mainstream. It's not sort of a special idea, if you will. So what I thought I might do in sort of 10 minutes is give you a sense of who Generation is, most importantly, our investment framework and why I said what I said, and then maybe share with you what we've learned over the last 16 and a half years that Generation has been deploying capital, and perhaps talk about a couple of sort of themes, if you will, or ideas that we see developing as we go forward, and also frankly share with you the challenges of sustainability in the world of COVID, and probably address the question that many of you have, which is, will sustainability and ESG be relevant in a global pandemic? And probably this is not a spoiler alert, but obviously we think the answer to that is yes. So I retired from Goldman Sachs 17 years ago, actually almost to the day, to help establish Generation. Today, Generation is about $30 billion of assets under management. We're a boutique fund manager. We are a sustainable fund manager, but I'll come back to what that means here in a second. And we manage equities, principally public equities, but we do have a very significant private equity business. We are a B Corp, but importantly, we are a very driven traditional fund manager, but we're also a mission-driven firm. And we can talk about that if you're interested, but fundamentally Generation exists for two reasons. One, to deliver outstanding results for our clients, and two, to prove the business case or help prove the business case that sustainability and ESG are relevant to the success of business, should be incorporated in investment philosophies and frameworks, and indeed should be the fundamental driver of economies. Our investment framework starts with a very important sort of belief, if you will. We do not believe, and it's important that I say this multiple times probably, that our investment framework is trading values for value. This is a critical point because many folks have historically believed that there is a trade-off to consider sustainability and ESG, and that therefore it is a less superior investment philosophy or framework. And that in fact, it in some cases is considered to be not a fiduciary line of approach. We fundamentally disagree with that. And our track record over this last 15 and a half years establishes that quite solidly. And we can talk about that if you'd like. But the point I want to make is that this framework that I'm about to describe is not about trading values for value. This is a fundamental, rigorous, traditional investment framework. And what that framework consists of is really three core tenets, if you will. The first is that long-term investing is best practice. The second is that sustainability factors or ideas or trends or challenges are drivers of economies. And actually they're interlinked and are increasingly so. And what we think of as we talk about sustainability isn't just climate change or the environment. It also includes challenges of health, challenges of racial and social justice, challenges of poverty, challenges of pandemics, challenges of communities, challenges of education, etc. So our thinking around sustainability is quite broad. We think of it as sort of drivers of change, and it's very critical that people realize that these issues are interlinked. And the third principle, or the third plank, is that environmental, social, and governance factors, ESG, are tools to help us understand businesses and management teams, what a company does and how a company does it. And we use these tools, both the sustainability as a driver of economies and ESG as tools to understand businesses and management teams as a framework within a traditional rigorous investment process. We are integrating sustainability and ESG into how we're deploying capital. And so when people say, well, what percentage of your alpha is due to sustainability or ESG, we say we have no idea. We think it's completely interlinked to the long-term success of business. So that is a critical point here. We do not think that you analyze a company or analyze an industry and then think about sustainability. It's all holistically considered in understanding drivers of economies and drivers of businesses. So what have we learned over the last 16 and a half years? One is we have reaffirmed what we knew when we started, is that investing is really, really hard. And therefore, to the extent that one can develop frameworks that are logical and that enhance the probability of delivering interesting investment results, then that's a better framework. And that's ultimately what we think we are doing, is that by developing a broader array of questions, a broader array of issues to consider, a broader array of factors in understanding management teams and businesses, we think we have a better chance, no guarantee, but a better chance of delivering strong risk-adjusted investment results. The common refrain, unfortunately, in sustainability and ESG is that it's a win-win. There are win-win situations for sure, but mostly they're trade-offs. And understanding how these trade-offs play out to the success of business is a critical factor or a critical issue that we need to consider. And these challenges evolve over time. And so what we thought perhaps 12 years ago or 15 years ago isn't what we think today, and things are constantly changing. And that's true for investing generally. The very best investors get it wrong a lot. And therefore, learning from mistakes is a critical part of being a great investor, and being inquisitive is a critical part of being a great investor. And I'm certainly not saying we've achieved that status by any stretch of the imagination. Jeff has, we haven't, we're moving in that direction. But the point is that understanding how these trade-offs work is really what you need to do. It is not a checkbox exercise. That's another a sort of fallacy, is that what you do is you get a series of just sort of generic questions and you go through them. That's definitely not the case of how one thinks about sustainable investing or ESG investing. It has to be relevant to the success of business. It has to be relevant to the economies and the industries that you're looking at. And you'll be disappointed if you use the same checklist for every single industry or every single company, because of course they're radically different in what drives the success of those businesses. And very important to conclude, and sort of what we've learned is, while there's no question that sustainability and ESG help you manage your risk better, it's not just about risk management. It's really about identifying companies and businesses that will deliver great long-term investment results. And those are the types of businesses we're keenest to invest in. And we can talk about some of the changes we see in capital markets as we're going forward as well, if that's of interest. I've said a couple of times that investing, of course, is about risk and return. And we are trying to maximize return relative to the risk that we're taking. And clearly, we need to take risk. We're an active manager or a fundamental manager, and our portfolios are concentrated. So we are taking risk. And clearly, we need to manage the return from that perspective. But I think it's critical that we start expanding how we think about risk and return to begin to think about impact. And what I mean by that is all business has impact. All investing has impact. And so many folks, I'm sure, have heard the term impact investing. Well, that confuses us a little bit because we think all investing has impact. And so the critical question here is, are you measuring it? Are you reporting on it? How are you trading off risk and return and impact? And what we're finding is that increasingly impact will be measured. And in fact, our clients are already requiring that we report on impact. So as you all are thinking about the investment management industry going forward, it is critical that the term impact become part of your lexicon, and it will clearly be a driver of the industry as we go forward. The last thing I want to share with you is a common refrain that we're hearing, or a common question maybe is a better way to say it. We're hearing from a lot of folks saying, well, gosh, we can't afford to be thinking about sustainability in ESG at the time of an economic crisis that clearly COVID has engendered. And we find that kind of confusing because, again, we think that sustainability and ESG are drivers of the success of companies and businesses. And therefore, it is not appropriate to say, oh, well, we have to put aside things that are long-term in addressing the challenges of COVID. That would be a terrible mistake. We need to think of the challenges around human health, planetary health, as well as economic and racial justice as really one whole triangle, if you will, of how these issues intersect in capital markets and in businesses. So just to the contrary, we think the term of Build Back Better, which was a WRI term that we started talking about in March, is a very relevant conversation, very relevant point to think about as we're talking about where we will or how we will reflate our economies in the coming years. So sustainability and ESG, in conclusion, are relevant to the long-term success of business. Therefore, they are urgently need to be considered in understanding the quality of business and the quality of management. And they are not a nice to have. They're not something you do once you've decided whether you like a business or not. They're critical to be integrated into investment frameworks. And if you do that, we believe you have a higher chance of delivering interesting, differentiated, risk-adjusted returns. Celia, over to you.
Great. Thank you for those great context-setting comments. And clearly, you have a lot of passion around long-term sustainable investing. We do as well as a firm. When you look at back in time at your evolution as an investor, how did you get interested in this so early before anybody was really talking about this? And how did the whole generation team really come together around this mission?
Well, it's really it's an important question because it is for us a mission. We really do aspire to be outstanding investors, and that's how we are judged, of course. And we also recognize that if we are not strong investors, if we do not deliver strong results for our clients, our advocacy work, our mission around proving the business case that sustainability and ESG are relevant to the long-term success of business, if we are a poor investment manager, our voice will be uninteresting and will be disregarded. So we know very well that, first of all, our clients have entrusted $30 billion of their funds with us, and that alone is a pretty daunting responsibility. But we also know that the mission of our organization is dependent upon great investment results. But the mission of what generation and its people are trying to do is really sacrosanct. And I've learned over the years that culture and values and mission are important. What we're discovering is that it's even more important than we thought. And that if you can build a business that is both robust commercially and excellent in terms of what it does, as well as mission driven, you can build really interesting or develop really interesting, robust business models. And when we're deploying capital, both publicly and privately, we are looking for businesses that are mission driven, and particularly in our private investing businesses, mission is often a way that we are able to differentiate ourselves with the great entrepreneurs who are also mission driven. But ultimately, our journey to developing sustainability or developing generation was based on this mission orientation, but also our experiences as investors and business builders. And we saw very clearly that, for example, in the financial services industry that we've both have been in for a little while, we know full well that culture and values and governance are drivers of success. And having experienced those important points, it was not very hard for us to as asset managers to recognize we needed to have rigorous approaches to that. It's clear that the challenges of the environment and the challenges of poverty are relevant to business, and that's becoming more so. And so basically, we looked at these questions, we looked at our investment framework and said, why wouldn't we do this? And we collectively said, well, let's see if we can establish the common sense of what we're talking about. And that's why I always go back to the notion that this is common sense. This approach is what we think is best practice investing. It just happens to have a critical mission attached to it. And let me just say also, I don't know if this will come up as we talk, but it's important that I say, I think the next 5 years will be the most important 5 years of my career. The challenges that we're facing today around climate change, the environment, social justice, racial justice, and human health are extraordinary. If we're going to achieve the Sustainable Development Goals, if we're going to achieve the objectives of Paris, we are going to have to fundamentally transform our economies and transform our economies in the next 3, 5, 7, 8 years. This is a tremendous responsibility, but a tremendous investment opportunity. And that's exactly how we're thinking about it. So I can go on for hours and tell you the story about how I met Al Gore or how Generation was established, but mostly my daughters say that's pretty boring. So maybe we should skip that for now.
That's great, thanks. So let me pull on that on some of those threads a little bit. You've talked about how all of these challenges are integrated, and I think COVID makes that quite clear how integrated the environment and the healthcare and income disparity and all of that is. But when you think towards the challenges and the urgency to get things done in the next several years to get on the right path, what do you see as the most important things that we really need to get right?
Well, we think the conversations, well, I will tell one story about the founding of Generation because it helps me answer the question that you're raising, which is a terrific question. So when I went to meet Vice President Gore for the first time, the original thinking around Generation was probably more around sustainable development and poverty. And that was kind of that's my orientation. That's what I've been most interested in over the years. Obviously, Vice President Gore's interest was and is in climate change. And when we first got together to talk about how we were thinking about the challenges and investing, what we realized is actually the question of climate change and the question of poverty was the same coin, but just different sides. And as we began to unpack that, we realized that that was true for multiple issues. And as we think about the urgency of decarbonizing our portfolios and transitioning to net zero, you cannot think of that unless you understand that we have to have a just transition. And clearly the challenges of social justice, racial justice, economic equality, these are all directly, they're urgent and they're directly linked to the challenges of transitioning to net zero. And our strong point of view is that if we don't get that right, the second bit right, we will not be able to address the challenges of net zero or the transition to net zero. So it has to be done urgently and it has to be done congruently. And by the way, health is clearly part of it as well. And it's always been. And the lessons around the importance of science, the importance of proactive action, the importance of leadership that we are learning in the pandemic are even doubly true for climate change in a just transition.
So how do you balance all of these various priorities in looking at companies that you're investing in? Is it merely acceptable to do no harm? Are you looking for companies that are really making change? How are you using this lens as you sort through all the various investment opportunities in your portfolios?
Well, it's really quite an important question, and I feel that Generation is very fortunate in many ways, actually, most ways. But one is that we're a very concentrated manager. We have 45 positions in our portfolio. I think some might say, "Oh, that's still pretty diversified," but relative to Goldman Sachs, that's pretty concentrated. And therefore, what that means is that we have great luxury to be very selective of the businesses that we invest in and own, and that's true in the private markets as well. And so we don't have the challenges of some of the very large asset owners or asset managers of thinking about that are basically universal owners. We don't have that problem. We have ideas on how to think about those problems, but that's not our issue in terms of deploying capital. So we have the luxury of identifying businesses that are part of the solution. They're driving to net zero, or addressing the challenges of communities, or addressing the challenges of health or economic access. So we are absolutely not interested in do no harm businesses. We are absolutely interested in businesses that are driving transformational change. That's easier to do in our private portfolios, but it's very possible. And we do seek to develop those sorts of capital allocations, or those investment decisions in the public market as well. And we've largely been successful in doing so.
So to push a little bit more on that, when you are looking at these different considerations and the impact that companies are having, all of this is interrelated, right? You can have companies that have excellent governance, that are doing really good things for the world, maybe tackling financial inclusion, or some other aspect on the social aspect of ESG, but maybe they have a fairly large carbon footprint. How do you weigh these different factors for companies? Do they have to be strong on everything, or are, as you said earlier, there are trade-offs here?
Well, this is why impact is increasingly important. When there are externalities that are not measured, it makes these sorts of questions, or these capital allocation questions, and both in the business itself or in the investor or asset owner, more challenging. And if things go unaccounted for, then you have poor capital allocations. So for us, and I think a second critical point is that, again, we are thinking of these challenges as economic questions. The questions of carbon and carbon footprints are, yes, it's about transition to net zero. It's about reducing our carbon footprint as a society or as a business, but there's also costs associated with that, and there's risks associated with that. So we would not just say, oh, well, this company is carbon intensive, but they're at least they're treating their employees well. We would not consider that to be a good investment. We'd be glad that they're treating the employees well, and of course they should do so. But if we are not pricing carbon into the footprint of the business, then that means that we are underestimating or overestimating, or the market, if you will, is overestimating the value of the business. And that wouldn't be a sound investment decision.
So to use some of the industry lingo, you're incorporating these transition and physical risks into the profit outlook for various industries. I think one of the challenges that everybody faces as tools and developments are evolving is the ability to really measure these. You talk about risk, return, and impact. How do we as investors, and how does generation seek to measure the impact? And I know you're involved in the TCFT, the organization from the Financial Stability Association, that's seeking to develop financial standards around climate related disclosure. Can you talk a bit about what you're doing there, and how you see the ability to measure impact evolving?
Well, it's a great question. It is, and it's really why I keep coming back to the importance of impact. And there are probably three, or, oh gosh, I'm sure there's more series of initiatives that are thinking about it. TCFD is, I think, the sort of the gold standard for thinking about net zero impact and disclosure. The Sustainable Accounting Standards Board is helping to expand how people think about reporting around sustainability. There's a initiative at that terrible school up north in Boston around impact accounts and why that is going to be increasingly important in impact measurements as it relates to financial accounts, which is really quite interesting. There's an initiative in London, but is really a global initiative led by Clara Barbie around developing best practice on impact reporting. And all of these initiatives are absolutely critical because, as I said, increasingly measuring impact will be a requirement to allocate capital, and it will allow us to more effectively allocate capital. But if I'm really honest, and I feel like Generation has been thinking about this for a while, I would give us at best a C on our impact reporting. It is very rudimentary. It's better than it was 5 years ago, for sure. We're very passionate about it, but we do not yet have, we meaning all of us in the industry, I think, have not developed the rigorous standards that we're going to have to develop over the course of the next couple of years to more effectively allocate capital to the challenges that we're facing. But the point you're making is a really critical one. Disclosure and measurement will be critical to how we build robust, fair, safe, healthy, no carbon economies in the years ahead.
You know, it's so interesting how many different groups are, you know, really seeking to attack this problem of reporting. We're also seeing evolution of organizations really centering around how to address the challenging problems of industry and carbon emission, find better ways to be able to continue on with our lives and produce what we need to produce and create energy, but do so in a more effective, carbon efficient way. How much are these organizations, you know, working with each other versus competing against each other to solve these challenging problems?
Well, I would say we could do much better in communicating and much better in working together. And one of the great things about TCFD, and I think it's been a terrific initiative, but what Mayor Bloomberg and Governor Carney sought and Mary Shapiro has led is a outreach to try to bring these groups together. And I think we've largely accomplished that, or directionally accomplished that. But that is critical. That's also critical for the NGO community. We need to do a better job working together and in basically ensuring that we're bringing best practice to these collective challenges. Conservation is something that near and dear to my heart, and we can do better by bringing WRI together with TNC, together with Conservation International, et cetera, et cetera. So there's clear work to be done on that. But I also want to say is we think about, I can't overemphasize this, the transition to net zero will be the most significant economic change in history. Everything we've done today will change in the next 5 to 10 years. That can change for the best. We believe that this will be an extraordinary opportunity to build back better, to develop our economies, our energy complex, our industrial complex, our mobility, our built environment, our food and agriculture. These are big segments of our economy that will evolve, will transform. And there will be winners and losers, but we as capital allocators are right in the middle of it. We have an opportunity to deploy capital in ways that we've never had in the last 100 years, to put it very, very mildly. And so this is a big deal, and we can't just think about it as incremental, or that it's going to just, oh my goodness, we're going to have just challenges. No, just the opposite. This is about building great, resilient businesses, developing really interesting jobs, and economies that are much more robust and resilient than what we see today.
You sound very optimistic, not just on the investment front, but on our ability to transform. Do you think that we are going to make it to net zero by 2050, or whenever, you know, the critical timing is?
Well, I certainly wouldn't leave it to 2050. Generation has made a commitment to be net zero in our portfolios by 2040. We actually think we can do it by 2030 and probably sooner. But again, Generation is very fortunate. We're a little company that can do these sorts of things. But we need to be targeting more like 2040 as opposed to 2050. The good news is the technology exists. There is some extraordinary, and the thing about sustainability, I should have said too, is sustainability and innovation. They're basically in the same part of the dictionary. I know they're different letters, but they're really the same thing. And for me, that's one of the most exciting parts of thinking about drivers of change, is that we're really talking about really interesting different approaches, technologies, innovations that exist already that can help us transform our economies in interesting ways. After saying all that, oh my goodness, this is going to be hard. It is going to be really hard because we have to transform significant industries. There will be pain. Therefore, we have to focus on the just transition side. There will be incumbents who will not be enthusiastic about change, for sure. There will be regulations or governments that will be unenthusiastic. And there will be setbacks. I think the notion of 2 steps forward, 1 step back, absolutely will be in front of us for sure. And there will definitely be folks who will lose a lot of money, including people who are investing sustainably will lose a lot of money. There's no such thing as forgetting. One of the challenges that we faced early on at Generation is that people said, well, gosh, the first green revolution after sort of 2008, 2009, so many folks lost money. Yes, they did. They lost money because we forgot the fundamentals of finance. Fortunately, Generation didn't, but you can't just deploy capital to transition to net zero in businesses that have no barriers to entry, as an example. That's not a wise use of capital. So we know that it's going to be hard. We are certain, though, that we have the ability to, and we just need to just get it done. And frankly, we have no choice. We have simply no choice. And so do I think it's going to be hard? Absolutely, yes. Do I think we're going to get it done? Absolutely, yes, because I can't think of any other outcome than that.
So I've been sprinkling in some questions from the audience, and I'm going to pull in some more now as we approach the end of our time together, which has flown by way too quickly. We still have about 5-7 minutes or so. But
I wonder why we only have one participant left. What? I'm just teasing.
As you think about what investors can do to help move along this transition while earning strong returns as well. You really focus on equities, both public and private equities, but there's whole portfolios out there. What are your thoughts about how investors should approach this? Should it be from a total portfolio perspective? Is equity the most impactful? And then there's a variety of ways to address this. Your firm really is focusing on sustainable, high quality companies with an integrated approach and impact on the private side. There's also plenty of passive sorts of investment strategies in both equities and fixed income. And there's activist strategies, as we'll talk about in the next panel. So when you think about, investors that are ramping up their capabilities to invest in this way, what advice do you have to them? Do all of this, should they beware of any traps related to greenwashing, using marketing labels without really having a lot of strong ESG fundamentals behind it?
Well, I think the most important question that capital allocators, whether it be asset managers or asset owners, need to ask themselves is, do you believe that sustainability and ESG are drivers of business in economies? If you don't believe it, then it's marketing. If you believe it, then you will want to deploy this framework across all of your asset classes. And yes, some are better developed than others, but this is not something you just allocate 5% of your your capital to, or your assets to, this is a fundamental belief. Do you believe that sustainability is driving economies, that climate change matters, that health matters, that equality matters, and they're interlinked? If you believe that that's part of economies, then you need to think about this. If you believe that ESG is tools to help you understand businesses better, and that it can include projects, that can include real assets, that can include fixed income or credit instruments, et cetera. If you believe that these are tools to help you understand the context of business and the context of companies and management teams, then all of your assets should be deployed with some form of sustainability and ESG as a framework. If you don't believe it, then this is not really a good use of your time. But I think you'd be making a terrible mistake if you don't believe it, because the notion of being holistic and understanding the context of which you invest seems to me to be pretty much common sense.
Got a question from one of the students out there, so need to ask this one. Can you offer any advice or guidance for students seeking a career in responsible investing? And what skills do you seek in new hires?
Well, I've always been reluctant to use the word responsible investing, because that implies that others are not being responsible. And I think all of us try to be responsible in how we're deploying capital. So we really try to use the notion of investing, and that helps me answer the question. Ultimately, we need great investors, because this is what sustainable investing is about, or ESG and sustainability is about. It's about understanding businesses and management teams, economies. It's about capital allocation. It's about understanding the broader developments in businesses and industries. This is why the transformation to net zero is so obvious and so critical, and understanding how that's going to pan out will be critical. But for us, it is also about mission. And when I started, 40 years ago, I was passionate about mission, but I felt that I kind of had to check my values at the door. Now, when I worked at Goldman Sachs, I didn't feel like I was doing that. Incidentally, I felt like Goldman Sachs had core values and business principles. But I certainly believe that if you're able to find organizations, in fact, you must find organizations that share in your values, and that you're proud of the mission that they're on, and then you're just excellent in the business that you're in, that's going to be a really interesting and fun way to work over the course of the next 10, 20 years. And as I said, I have underestimated the value of mission over the course of the last 15 years. We don't underestimate it now, that's for sure.
Well, thank you so much, David. This has been a really interesting conversation. It's been a delight to have an opportunity to hear from you. Our time has remarkably run out, so I'm going to thank you and turn it back over to Rodney Sullivan.
Celia, thank you so much, and thank you very much, everyone.
Excellent, thank you. We had a record-breaking attendance for UVic with over 400 joining us today, so thank you to everyone for being here with us. Before we close, I want to first thank our event sponsors, Sands Capital, McKenna, and CFA Virginia, for their partnership in making this event possible. I also want to mention that later this afternoon, our students will be leading this year's stock pitch competition, the Darden Investing Challenge. We have over 12 schools participating, and we're going to determine which team has the best idea for investing around the COVID crisis. You are all invited to join us at around 3:15, and that's when the final round of the competition is expected to begin. We're going to send you the Zoom details in an email that will be coming your way in just a few minutes. Also, next Friday, November 6th, from 1 to 2 p.m. Eastern Time, we have another special guest, Alex Edmonds, the professor of finance at the London Business School. He'll be joining us to discuss his insights on responsible investing. What is it? Does it work? And how to do it? Registration details can be found on our website, and we'll also send you an email a little bit later so you're able to register. So we look forward to seeing you there. Last and most important, we also want to give a very special thank you to the many dedicated people who volunteer their time on the conference executive committee, our Mayo Center advisory group, and to our students, many of whom have volunteered their time and talent towards putting on a successful conference. And finally, a special thanks to the amazing Darden team, Aaron Fernstrom, Stephanie Swing, and Asmi, and the many others who have all worked so tirelessly to make a most successful event again this year. So thanks to all of you. With that, I will now close this 13th annual UVA Investing Conference. We ask you to please stay safe and well, and we look forward to seeing you again soon.